A few days ago, I read an article in the Wall Street Journal talking about the magic number that you need to retire, and this so-called magic number was based on a survey of almost 4,600 individuals who said that it would take $1.46 million to retire comfortably, and this number is up from $1.27 billion just 1 year ago, which might give us some insight on how people are feeling about retirement. You know, one of the biggest fears that a lot of people have when it comes to retirement, especially those who are approaching that stage in life, is not having enough. You know, they're afraid that they're going to run out of money before they die. And based on this higher number, it seems that fear is getting worse. People on average feel that they need a 15% larger nest egg now than they did just 1 year ago. And truth be told, as far as magic numbers go, there is no real magic number that will tell you whether or not you're eligible for retirement. It's a totally subjective thing that will vary depending on your circumstances, which does beg the question, so how do you know when you can retire? And how do you know when you have enough? Well, looking at it from a dividend investor's point of view, if your goal is to live off dividends in retirement, then it's not so much about having a certain portfolio value. Instead, it's more about how much passive income you're generating when you go to retire. That's your magic number, and if you know what that is, you can reverse engineer it to calculate how much you'll need to have invested to generate that amount of income. And real quick, while we're on the subject, I'm curious to know, do you have a certain income number in mind for when you plan to retire? Like, how much dividend income do you want to have coming in before you decide to ultimately leave your job for good? Let me know in the comments below. But anyway, getting back to this magic number stuff. For example, let's say hypothetically you want to be generating $60,000 per year in passive dividend income in retirement. In reality, for you, it may be more, it may be less. This is just hypothetical, but $60,000 is a nice round number. You know, $5,000 coming in every month. That's not too bad. To figure out how much you'd need to have invested to generate that amount of income, you would take that income amount and divide that by the dividend yield of the stock or the ETF or the average yield of your portfolio, and that will tell you how much you'll need to have invested to generate that amount of income. Now, in our example here, let's say that your portfolio as a whole has a 3% dividend yield. If your goal is to generate $60,000 per year, that would mean you need to have $2 million invested to bring in that amount of income, which is obviously more than our so-called magic number from earlier. Now, running it again, let's say that we have that magic number invested, that $1.46 million. To generate $60,000 per year in dividends, your portfolio overall would need to have about a 4.1% dividend yield, which is a bit on the higher side. Here's the kicker though, this calculation only applies if you are lump sum investing all of that money today. Like if you had $1.46 million sitting in your bank account and you just decided to invest that all at once in one foul swoop, but that's not really how this happens. Unless you hit the lottery or suddenly receive some huge inheritance, you'll build your portfolio with small, consistent contributions over time, which means that the math is a bit different. Doing it this way, when dividend growth is allowed to occur over time, you'll likely be able to generate more income with a lower portfolio value. And by the time you go to retire, your yield on cost of the shares that you own will likely be considerably higher than the 3 or the 4.1% yield that we saw a moment ago. And in case you've never heard of this term before or are not quite familiar with it, yield on cost measures how much income you're generating compared to the original cost of the shares you purchased. So for example, imagine that you buy a stock for $100 and it pays $3 per share every year. Your dividend yield and your yield on cost upon purchasing would both be 3%. But let's say that this company has a tendency to increase their dividend payments every year, which is the type of company you'd want to invest in. Over time, your yield on cost for those shares that you purchased at $100 would increase, and your cash flow return on those shares would increase as well. To paint a picture of what this looks like, let's say that at some point in the future, the stock has increased in value and is trading at $125 per share. And throughout this time, the company has increased its dividend to the point where now you're receiving $3.75 per share. The current dividend yield on that stock would still be 3% because you take that $3.75, divide it by $125 per share, and your yield would be 3%. But your yield on cost is going to be higher, because you paid $100 for the original shares, and those shares are now paying $3.75 instead of the original $3, your yield on cost has grown from 3% to 3.75%. Now, as a real-life example of this, let's take a look at a company like Lowe's. Lowe's has been increasing their dividend for 60 straight years, and as you can see, the yield itself isn't very high, only 1.84% if you bought shares of Lowe's today, but the dividend growth is pretty substantial. They've increased the dividend on average by 18 1.65% per year for the last 5 years. Now, if you were to go back 10 years to April 2014, the dividend yield at the time really wasn't all too different than it is now. In fact, it was lower then. And if you were to buy shares of Lowe's on April 8th, 2014, you'd only be locking in a 1.5% yield. However, if you just held on to those shares from then until today, because of the dividend growth, your yield on cost would be off the charts. And your initial 1.5% yield would have grown into a 9.5% yield on cost, which is insane. Now, applying this back to our hypothetical example from a moment ago, because dividend growth has occurred and ideally will continue to occur over the years, the growth of your portfolio and your dividend income is exponential, which means you shouldn't need a $2 million portfolio to generate $60,000 of income, and you might not even need a $1.46 million portfolio to generate that same amount of income, but that's what we're going to figure out next. We're going to forecast what your portfolio might look like and how much income you'd have 20 or 30 years down the road if you started investing today and started working toward that magic $1.46 million number. And for our first example here, to keep it simple, we're just going to start with the S&P 500. We'll put all our eggs in this basket and put 100% of our portfolio into VOO, or VOO, which is the Vanguard S&P 500 ETF. And I know going 100% into the S&P isn't really a dividend-focused approach, but still, VOO does pay a dividend, and I don't think you can go wrong investing in the S&P 500. It's a pretty tried and true approach. And taking a look at VOO's dividend stats, like I said, they do pay a dividend, but the stats aren't really anything to write home about. The yield is definitely on the lower side at 1.35%, and the 5-year growth rate isn't anything crazy either at 4.65%. But if we look at the 10-year dividend growth rate, so zooming out across a little bit longer period of time, the dividend growth rate here is a lot better at 7.14%. And we're going to use something closer to this longer term number here as we forecast into the future. And with that said, these are going to be our inputs for our portfolio projection here. So we are going to start things from pretty much ground zero. We're going to start with $1,000 in this portfolio. And in our example, we're going to assume that we're just investing into a Roth IRA, a tax advantage account, and we are going to max that out every single year. So our annual contribution will be $7,000. And then we've got our dividend stats here. The starting yield will be 1.35%, just like we saw a moment ago. But the dividend growth rate, it's going to be a little bit more conservative than the 10-year rate we saw earlier. We're going to use 6%, and then we'll account for an average share price appreciation over the years of 9%. And looking at the results here, after 20 years of investing $7,000 just into the S&P 500 based on these inputs, the portfolio value will be $406,564. So we're still about $1 million short of the $1.46 million magic number, and the dividend income at this point is really nothing, $3,149. Like I said, the S&P 500 is not really known for its crazy dividend income, but at this point, after 20 years, your yield on cost would increase to 2.16%. So it would go from 1.35% up a notch to 2.16%. But anyway, moving on, looking at the results after 30 years, the situation gets a lot better. At this point, you'd have $1.1 million in this portfolio. So the portfolio value itself would grow pretty exponentially, but after 10 years, the annual dividend income only doubles. At this point, you'd go from $3,149 to $6,644. So you're definitely not going to be able to live off dividends with this number right here. But at any rate, looking at the yield on cost, this would be sitting at 3.04%. So that yield on cost does continue to climb. And then going just a few more years into the future, somewhere between 32 years and 33 years of investing $7,000 into the S&P 500 based on these inputs, you would have arrived at that magic $1.46 million number. We can see that after 33 years of investing, the portfolio value would be about $1.5 million, but still you would fall very short in terms of annual dividend income. You'd only be bringing in $8,160. So you definitely would still have a long way to go if you were trying to live solely off the dividend income from your portfolio. And at this point, your yield on cost would be 3.39%. So once again, if your goal is to live off of dividends, then the S&P 500 may not be the best approach for you. I mean, if you were to go that route, you would likely have to sell off some of your shares in retirement to fund your livelihood, which is fine. That's a strategy that works just fine. But I know some people are a bit against doing that. They'd rather just live strictly off the dividend income. Which brings us to our next example here. Now, we're going to do the same exact thing, but with a classic dividend growth approach. And there's a lot of great dividend ETFs out there to choose from, like DGRO, VYM, and VIG. But truthfully, I have a hard time using anything other than SCHD in these examples because it has the best dividend stats out of the bunch, and it's generated some really solid total returns over the years. Looking at SCHD's dividend stats, just starting here with the yield, this is coming in about 2% percentage points above what we had with VOO. So the starting yield is a lot higher. And in fact, this is about what your yield on cost would have been after 33 years of investing in the S&P 500. So starting yield a lot higher, 3.38%, and the 5-year growth rate is considerably higher as well. This is coming in hot at 11.8%. And like I said, this is going to be more of a classic dividend growth approach. So I think we're going to see a pretty big difference in terms of dividend income with this. But anyway, looking at our inputs here, we're going to take pretty much the same approach as we did with VOO. We're going to start with $1,000 and invest $7,000 every single year into this portfolio. And once again, we're just going to assume it's into a Roth IRA. We're maxing that out every year. And over here with the dividend stats, we're going to use that 3.38% starting yield. But as far as the 5-year growth rate goes, we're going to be a bit more conservative. So instead of using something closer to 12%, which is what SCHD's 5-year growth rate was, we're going to use 7%. And then in terms of share price appreciation, we're going to go a bit lower than what we had with VOO. We're going to go 6%. And then looking at the results here, after 20 years investing into SCHD, you'd have about $400,000 in this portfolio, which is not too shabby, but already the annual dividend income is considerably higher than what you would have had with VOO after 30 plus years of investing. After 20 years with SCHD, you'd have about $16,500 coming in, and your yield on cost would be much higher, coming in close to 11%, which is very impressive. And then fast forwarding 10 more years, after 30 years of investing into SCHD, you'd have almost $1.2 million in this portfolio, and your annual dividend income would be looking great. You'd have almost $54,000 coming in per year, and your yield on cost would be about 23.5%. And then fast forwarding just a couple more short years, after 32 years of investing into SCHD, you would finally arrive at the magic $1.46 million number here, and your annual dividend income would be over the mark. You'd be over that $60,000 you were looking for, and you'd be bringing in almost $68,000. And furthermore, at this point, after 32 years, your yield on cost would be 27.75%. And with that said, it's definitely important to keep in mind that this is just a projection based on what may be faulty inputs, okay? And the future could play out in a completely different way than what we've seen here today. But either way, if you're looking at all of this thinking, geez, 30 to 35 years is a long time to live off of dividends, and there is a faster way to get there than what we just talked about. And in this next video right over here, I'm showing you what that fastest way is, and also share with you why the fastest way may not be the best way. So click right over here to learn all about that, and I'll see you in the next one.